Hello everyone, welcome back to our Accounting 210. In this video, we continue with chapter 6, cost behavior. So we focus on the last learning objective 6. We said that in this video, we focus on a new format of the income statement. So we will learn something called a variable costing method. Because at the beginning of the chapter, we talk about cost behavior. We said all the costs, they can be separated as the variable cost and then fixed cost. So we will, based on this standard, separate our total cost to this part and prepare our income statement. It is also called as the contribution margin income statement. It's also called as this one, or it also called variable costing So it's also called as variable costing income statement. Variable costing income statement. I remember our traditional way when you learn the financial accounting or when we learned our cost of goods sold. The traditional way is we said is the revenue minus cost of goods sold, right? We have been talking about this in chapter 3 and chapter 4. We get our gross profit or gross margin. We minus all the period cost. Remember, we minus all the period cost, or we call it operating income. We get our operating income. Operating expenses, sorry about that. We minus all the operating expense, we get our operating income. So this is called our traditional income statement. This is used for the annual report. This format follows the US GAAP, and when for the external reporting, when you have the financial statement filed with the SEC, you have to use this one. This is also called absorption costing method. It's for external. That is why you have learned this in your financial accounting, because this follows the US GAAP requirement. But we also said that all the costs, they can be separated to variable costs and also fixed cost. So some people said, how about I prepare my income statement based on variable cost and based on the fixed cost? So the logic will be your revenue, we first minus all the variable cost, right? We give this also a name called contribution margin. So this is why we call it a contribution margin income statement, because we have a new terminology is the contribution margin. Then we minus our fixed cost. We can also get our operating income. This is called as the contribution margin income statement. It also is called, as I said, also called as variable costing income statement. And we only use this for our internal reporting. You cannot report this to the SEC. It's only for your personal internal use. Okay, so you get the general idea. We have this as our external reporting absorption costing. We have this variable costing as the internal reporting purpose. You will say, oh my goodness, so we have these two formats. Why it's a big deal? So, I don't really care. Students said, well, I care. It doesn't bother me because you got operating income here, you got operating income here. What's a big deal? So first thing, it's a big deal because you have a different, the partial number. You got this one as gross profit, you got this one as the contribution margin. And why it's a big deal? Because this operating income may not be the same number as this operating income. This is the fun part, right? Sometimes they will be the same. If they are the same, maybe it's not a big deal, honestly. Like you do math first or you do English first, it doesn't matter as long as you get the same amount. But sometimes this operating income will be higher. Sometimes this operating income will be higher. You say, what the? So we will look at the detailed number and then figure out why they may be the same. Why they are not the same? You know, I know it's a lot of things to cover in chapter 6, so I don't require you to do the fancy detailed calculation. But you have to know the general concept and then the conclusion so that you will be ready for the multiple choice. I really don't want to torture you, you know, give you a lot of details calculation. You have a lot of things to cover already, and then we will talk more detail in chapter 7 for the variable costing. So for now, your job is, you know, read textbook, get the concept, get the conclusion, so you will be ready for the multiple choice. I don't think you will have a problem for this part, okay? Now let's look at this one. We go to the detail, we talk about absorption costing. That's what we have learned, right? That's what we have learned. We use our revenue minus cost of goods sold. We get our gross profit, we minus all the period cost, we get our operating income. So we said all the manufacturing related cost, okay, no matter it's fixed or variable, as long as it's manufacturing cost, what? Direct material, direct labor, and manufacturing overhead, right? So all these three parts, they will be our product cost. Remember, so that goes to your what? That goes to your work in process, and then it goes to finished goods, and then it goes to cost of goods sold, right? So as long as it's our manufacturing cost, product cost, direct material, direct labor, and manufacturing overhead, then they will be our product cost. All the other costs will be period cost and will be expensed in our the same period. So when we talk about product cost, we didn't care it's variable cost or it's fixed cost. So it can be variable product cost. It can be fixed product cost. Direct material, direct labor, they can be variable cost. But manufacturing overhead, like the utility, like the insurance, like the depreciation, they are fixed cost. But when we do our absorption costing method, we don't care. I said, hey, I don't care your fixed cost or variable cost. As long as you are product cost, I put you in the manufacturing part and become my inventory, and I will expense you when I sell you. Okay, so we focus on its product cost or period cost. We didn't care its variable cost or fixed cost. That is why we call it absorption costing. It absorbs all the manufacturing cost, no matter it's variable or fixed. It just absorbs. It absorbs all the variable. It absorbs all the manufacturing cost. It absorbs all the product cost, regardless variable or fixed. We do not care. We just put in our product. That is why it's called absorption costing method. Read it with me, right? Why? Because it absorbs all the product cost, We don't really care it's variable cost or it's fixed cost. Direct labor, direct material, mostly variable cost, but manufacturing overhead, mostly fixed cost. We do not care. Okay, now we look at our next one, variable costing. We talk about this. We only focus on the variable part in this method. In this method, we only focus on what? We focus on manufacturing, yes, but only variable manufacturing. Okay, this is the key word. You read it, repeat it. We only focus on variable manufacturing. Two parts. First, has to be manufacturing. Second, has to be variable. Okay, you have to meet those two criteria. Some people say, oh, sales commission, that's variable, so it will be our product cost. No, because it's not even manufacturing cost. It has to be variable and manufacturing together. Most likely, direct labor and direct material. Okay, so if it's just a variable, not enough. If it's just the manufacturing, not enough. it has to be variable manufacturing cost to be treated as the product cost. Okay, this is the key word. Okay, if I ask you, hey, sales commission is a variable, so it should be product cost. No, that's wrong because it's not manufacturing cost. Okay, so it's only used for internal. It's only used for internal. Sometimes it's good for internal because of these reasons. We talk more detail in chapter 7. But you know, now you put two different things in the product cost. For absorption costing, it absorbs all the manufacturing cost. For variable costing, it only focuses on variable manufacturing cost. So let's look at an example. As I say, I don't expect you to do the detailed calculation. So let's look at the example together, and hopefully you feel better after doing these numbers. For variable costing, you have for variable, this is the company, you have all this data, you have the variable cost, you have fixed cost, and then you have other information. So let's look at this. So we have a variable, we have fixed, we have other information. Variable, you can find out. Variable, you can be variable manufacturing or variable non-manufacturing. You have direct material, so this is product cost, direct labor, no worries. Variable manufacturing overhead. Okay, so you have variable manufacturing overhead, okay? And then you have variable operating expense like sales commission. So this is variable, but it's not manufacturing, it's operating cost expense. Fixed cost, you have fixed operating, you have fixed manufacturing, and you have fixed operating. So I use this one as the operating, so I'll put it here. I use this as the operating. I use this pink as the product, as our just the manufacturing. Okay, I'll highlight it. So you can say you have a variable, but variable has this manufacturing and non-manufacturing. You have fixed manufacturing and fixed non-manufacturing. And then you produced 40,000 units, selling price is 100, okay? So my first question, under absorption costing method, what will be included in your product cost? Under absorption, hear me, it absorbs all the product cost. So under absorption, we have a direct material, direct labor, variable manufacturing, and fixed manufacturing overhead. As long as it's manufacturing, it absorbs. I'll ask you next question. Under variable costing, what will be included as your product cost? Variable costing only includes variable manufacturing, okay? Only includes variable manufacturing. So this is direct material, direct labor, variable manufacturing overhead, no problem. Fixed manufacturing overhead, no. It's the manufacturing, but it's not a variable manufacturing. So that's not included as our product cost. You will say, how will this bother? Let's look at it, keep looking, right? Keep reading. So for absorption costing, we said the manufacturing cost per unit, the product cost will be direct material. We said direct material, then direct labor, variable manufacturing overhead, and then fixed manufacturing overhead per unit, right? We said the total is 1 million. Look at here, total is 1 million. We produced 40,000 units. So we allocated 25 for each one. So for absorption costing, it absorbs all these parts. So totally we have all these parts. We got $75 per unit. For variable costing, it only contains the variable manufacturing. It only contains variable manufacturing. So we said direct labor, direct material, and then variable manufacturing overhead. But we do not include the fixed manufacturing overhead. We do not include the fixed manufacturing overhead for our product cost. Read this, under variable costing, we don't include the fixed manufacturing overhead as the product cost. So for each unit, your product cost under absorption costing is 75, under variable costing is 50. How will this affect your income statement? You answer this question. How do the inventory affect our income statement? Remember, we said for our inventory is sitting as our asset, but only when you sell them, they will become cost of goods sold. They will become cost of goods sold. So let's say why I say sometimes the operating income under both methods, they are not the same. Look at some numbers together. When we use our income statement, okay, for the traditional, when we talk about traditional, this is the absorption costing. So this is our absorption costing, what we have been doing. If we sell 40,000 units, each one is 100. So we got our revenue called cost of goods sold, 40,000 times 75. We got our gross profit. We minus all the operating. This is the fixed. This is the variable. So we get our operating income. Okay, no problem, 620,000. When we use our contribution margin income statement, which is also our variable costing, so we also do this. We use our sales revenue minus all the variable cost. Right now, we don't call cost of goods sold. We just minus all the variable cost. Variable cost, we have a variable product cost, we have a variable operating cost, we got our contribution margin. We minus fixed cost, fixed overhead, manufacturing overhead, fixed operating. You say, hey, professor, you are wasting my time. What are you doing, right? Look at, you are wrong. Look at this number. This one, 620,000. This one, 620,000. You don't know what you are talking about. You are not a good professor. I will quit your class. I said, wait, give me a second. I see what the magic in next video, but for now, you are actually right. So in this situation, our operating income, they are the same, right? They are the same, 620,000, 620,000, they are the same. So am I wrong or not? I'll answer that question in my next video. So let me know if you have any question. I'll see you in the next part. Thank you.